is that some retailers have done well. Is that yet reflected in REITs?
Well, the retailers index is bottomed in August, and it's up 10 or 15% since August because the comp store numbers weren't as bad as people thought. Margins are improving, and there are many retailers, whether it's the Nordstrom's, the Gap, et cetera, Urban Outfitters, their e-commerce platforms are taking off or doing better. So it's been good for retailers because they've embraced e-commerce, and they've started to put up modestly better numbers since August. So the apparel index is up materially since then. In terms of the A malls, again, I would say that they're recruiting more of the e-commerce type retailers to their properties, but they're still impacted by what's going on in terms of a shakeout of department stores. For instance, Nordstrom's had earnings about a week or two ago, and that's clearly a department store that's in the A malls. Yeah. So they had comp store sales of down, say, 2% or so. Their e-commerce platform, or products they sell online, the sales trend there has been about plus 9%. So the e-commerce strength of, say, a Nordstrom's is much stronger than the bricks and mortar, which was 1.9% or so in the third quarter, negative 1.9%. So I think the A malls, though, have been showing decent numbers. In the third quarter, their comp store sales were up about 1 to 2.5%.
Steve, how reliant are these malls on just a handful of companies to really succeed? And how are those handful of companies getting on right now?
Okay. The A malls, and we define an A mall as a mall that does, say, $500, $600, $700, $800, $1,000 a square foot in sales. And it's typically a mall that's anchored by perhaps a Neiman Marcus, a Nordstrom's, but also a Macy's. And then whatever the hot restoration hardware could be in the mall, the A malls, that is, some restaurant concepts. And they're bringing a lot more restaurant concepts and non-apparel concepts to the A malls because that's where the demand is, as well as, let's say, a Tesla store, obviously the Apple stores, the Samsung stores, products of that nature, Bonobos, et cetera. Warby Parker is going to Class A malls. So they're doing it that way. It's going to be a process, though, because they have to weed out some of the weaker retailers that have been losing to e-commerce.
We've had private equity start coming into the mall space as well. What do you think about that from an investor standpoint?
Well, it's been good for us because it's caused the stocks to go up. The big event was about 2 weeks ago when BPY, Brookfield Properties, bid $23 a share for General Growth, GGP, and that was about 15% higher than where the stock was trading a couple of weeks ago. The interesting thing about that story is it's going to lead to price discovery in Class A malls because the big disconnect, Alex, has been that the regional REITs are up 6% year to date, the malls are down 10%. The typical mall a couple of weeks ago was trading at a 20 to 30 to 35% discount to NAV. The question was, who was right? And the BPY bid for General Growth Properties, which is $23 a share, implies about a 6 or a 6.2% cap rate. So a valuation that was lower than many people's estimates of what A malls traded at, because the typical NAV estimate for GGP was $27, $28 a share, and this bid came in at 23. But we'll see what happens in the bidding process. I would say that Brookfield, which is affiliated with Brookfield Asset Management, is a very sophisticated buyer of assets. So they understand the cost of capital and they understand mall fundamentals because their entity owned 35% of GGP before they made this bid. And the chairman of GGP is Bruce Flatt, who's the chief executive officer of Brookfield Asset Management.
Interesting. The valuation, interesting. We also spoke with Sam Zell a couple weeks ago, obviously big retail, a real estate investment guy, and asked him sort of where the value was in all the REITs. And here's what he had to say.
We have three different REITs. One is multifamily, one is RV and mobile home park, and one is office. The office one is the one that I think would be most threatened, and that's the one we've converted to almost cash. The multifamily one is very well positioned, but definitely affected by supply and demand. And the mobile home RV one is the best performing REIT since the modern REIT era on the basic that there is no new supply.
Steve, what do you think?
Well, I agree with his general commentary. He didn't address retail, but he did speak to...
he didn't want to own any. That's where
he hasn't owned any
his best performance
in a long time, but the manufactured housing business is interesting because they're not building plots for the manufactured homes, so that's good. He didn't really comment on retail or retail REITs, but he hasn't really owned much of that in the last 5 or 10 years.
Right, and I think that the point is that there's just not the kind of value that you would like to see, that it's still too risky. And some distressed debt investors I talk to from private equity say, we don't want to touch it because there's too much washed out, there's too much risk.
Well, there's a winnowing out process in bricks and mortar retail, and it's painful. And what I've emphasized on your show so far is the A malls, but the B and C malls have really gotten crushed in terms of value. We've seen value declines of 25 to 50% on the B and C mall properties, and we track that through, frankly, foreclosures in the CMBS market. So there have been a pickup in that, and those are the malls that do, say, $325 a foot in sales or less. And so they're not really in the GGPs, they're not in the Simons or the Mace Riches of the world, but they do exist in the marketplace, and they sometimes have securitized debt. And when they go into default, it becomes a market transaction. So we see the value destruction there, and that's where the declines in occupancies and rents is really most dramatic, because most bricks and mortar retailers still want to have a store concept. They're fine with that, but they really want to zero in on the most productive locations. Say here in New York, the Short Hills Mall, which is nearby, does about $1,300, $1,400 a square foot in sales. The retailers want to be there. But in the tertiary malls, say 10 or 15 miles west of there, the sales drop off dramatically to say $400, $450 a square foot in sales. And so the landlords of those properties are under rent pressure and occupancy pressure.
Yeah.